All right, welcome back, guys, to another episode of the Crypto Alpha Podcast, episode number 4. It doesn't seem like a day goes by that there's not more interesting things happening in the space, but that's why we love crypto. Unfortunately, the last couple episodes, the interesting has been a lot of the downtrend in the market. A lot of various counterparty risks, liquidations, putting a lot of downward pressure on the entire marketplace. But it looks like we are having, or at least enjoying temporarily, a little bit of a bear market bounce after Bitcoin was pushed well below 20,000, dancing around the 17,000 level. We've bounced back to 20,000. So I'm here today, as usual, with my friends at Crypto Alpha, Andrew Riley and Brandon James. But we do have the pleasure of a special guest, and this is Hannah Hamilton with Genesis. Hannah, welcome to the group. And you had told me before we started the call that you would have preferred I introduced you as Hannah Jo Hamilton. So I'm making up for that mistake now. Welcome to the chat.
Thank you. Yeah, happy to be here. Always happy to talk about crypto or anything related, but especially at times like these.
So you're senior DeFi specialist at Genesis. A lot of
Mhm.
what's going on, what people don't realize, or I'm sure some people do, but it feels like it all started. I mean, we are kind of heading into a bear market with equities at the start of the year. Crypto was already starting to slide, but it really kicked off with Terra Luna. Now we're seeing some issues with Celsius. I mean, this is what you thrive in, right? This is your specialty. I mean, this is really all DeFi. I mean, I think sometimes people don't quite understand DeFi, or they only look at it as some of these random staking protocols. But this is your world. Do you want to share kind of what you've experienced or your perspective of what's going on, at least the last couple months?
Yeah, definitely. So I guess a little bit on my background, just to kind of share why this is my world and how I've gotten here. I came from traditional finance where I was an actuary. So that's where the kind of risk mitigation and risk analysis comes into it. So aside from being DeFi specialist, I also kind of focus on the risk. So that segues even more into this market because we're seeing quite a lot of risk within it. And especially just seeing how kind of the Terra Luna ecosystem did collapse. We're seeing the trickle effects of that and how very many people did not understand the counterparty risk that they were taking on. That being just if say, give a loan to someone and they end up not making good on that loan, what that does to the rest of the market, which we're really seeing with the Luna fiasco and then Celsius going insolvent on their ETH position, which caused some market panic run on ETH, and just generally that trend across the market, which we've seen in traditional finance systems before, but this is really the most catastrophic time we've seen it within crypto and DeFi.
So before we dive a little deeper into that, can you
Mhm.
give us your version, or at least how you would define an actuary, so everyone can kind of follow along? Because
Yeah.
I think it's important. I think it brings a lot of credibility to your opinion in this space, not just because you've got a cool title at Genesis.
Totally. So, an actuary is a big combination of finance, economics, mathematics, data analytics, and trying to predict the future with statistics. So, that's a lot of technical terms. I can say that my mom is an accountant, and when I declared my major, she said that actuaries were the only ones that accountants made fun of because we're the super nerds. So, what we're mostly leveraged for in companies in traditional finance is prediction models and data analysts or data analysis along with risk mitigation. So, I used to work at Cigna Health Insurance, where I was in charge of using statistics to predict how many people that we're insuring would become, sick or cost us a certain amount of money. So that's kind of what an actuary is. And with that background, I was always super interested in finance and statistics, and I ended up with a role that was more finance focused. But after a while, just kind of started getting bored with the traditional finance world and got into crypto, where a lot of these risk models haven't really been built out yet. And there's certain metrics that you can look at different within this space. Like we have all this on-chain data, but what do you do with it? And like just a very quick example for that is something super important within this space to look at with a new project or something in DeFi would be look at Etherscan if it's a ERC20 token, and then see the wallet concentration of who's holding, more than 1% of the total tokens, because that gives them a lot of power and they could crash the market and things like that. So that's kind of what an actuary is, and then how I've applied like those skills to viewing crypto markets, even though there is much more than that, but I won't get too in the weeds.
So it's funny. Your mom says actuaries are who the only people that accountants make fun of, or that you're the nerdy batch in that world. I'm a math major, graduate with math degrees, and we always looked at statistics as the fake mathematics, right? Because it's not a concrete finite solution, and that's not to take anything away from it, because I did absolutely horrible in statistics. So I could solve calculus problems, but when it came to probabilities, that lack of finite solution really made it challenging, and that's really where the value add of this applied mathematics comes in, because none of us know the future. And what you're trying to do is not just mathematical in the sense of practicing mathematics, but it's also looking at the real life circumstances and liabilities of these different types of counterparties, as you mentioned. And before we go any deeper, it would be also helpful if you could, because that's a term that's it's so important and used so often, but I don't think people appreciate enough what a counterparty can ultimately mean when you're in finance in general, but just when you're looking at the intersection of markets.
Yeah, I agree. Which might be the understatement for this industry, sadly, right now. So yeah, I mean, counterparty risk is one of those things, as you're saying. I guess that's a very good caveat, is that statistics do not have a finite answer, which is actually why I like it, because that's kind of even more of a dynamic view into things, which I think are very dynamic. I think a lot of things in markets there is no perfect answer for. If there was, whoever figured that out would be a multi-billionaire. But yeah, one of those risks affecting the markets being counterparty risk. So just to kind of paint the picture there for people, if I have, say $100,000 and I want to earn yield on it, but the bank account yield is only, let's go with the savings account average of 0.07% from last year. So we have this extremely low bank account yield. There are some other options, but to make it super simple, say you need $100,000 and I loan it to you, and you're going to pay me 4% interest annual on that. So the counterparty risk would be the risk that someday you can't pay me back, and there might be, say you take that $100,000 and you're going to invest it into Luna or a crypto, something that's kind of seen as more risky. If I'm watching the balance and how you're doing, and that $100,000 gets below a certain amount, like say 80% of the original value, then I can say, okay, then I'm going to ask you to top that up and add more collateral, or else you have to give me all of that money back. If you get to that $80,000 because you've sustained some losses, there is a chance that you just default on the loan, and the risk that you personally do that is the counterparty risk. So before giving you that loan, I would probably look at, what is the yield, but then also use statistics to find an imperfect probability that you default on that loan, but a good guess. And so counterparty risk is just trying to measure the strength, the financial strength and reliability of a counterparty. And in an economy like we saw over the last 2 years, where there was really cheap money as interest rates approached zero, and we saw insane inflation and tons of new money entering the market, a lot of people were looking for investments with some yield. So it could be possible that, within the market, people lowered their standards of counterparties in search of yield, or everything seemed really safe because there was so much money flowing around. But historically, whenever that happens and there's so much leverage in a market as well, once things start to go down, you see that really shake up the market, and you see a lot of people figuring out which counterparties were strong enough to keep up their end of the deal. But it does lead to a much higher magnitude event than in a system without all that leverage and low interest rates. So we're kind of seeing the perfect storm of that now, with just going from low interest rates to so many rate hikes, which normally crashes a market, but now it's even further magnified. So just an example, and then kind of that's where I see it affecting our market currently.
All right, so this kind of leads us into one of my, I want to say favorite topics, but it's just something that I'm passionate about. I think partly because it drives me crazy. I think the underlying aspects of it are responsible for so many issues in the world, particularly economically. So, Brandon and Andrew, you might want to just grab a beer and relax, because I feel like Hannah and I are going to have a chat here for a minute. But having this conversation, it makes me, I think, taking a step back, like, so you were an actuary at this insurance company. That's, I feel like, a very different application of your skill set and your knowledge versus the finance world. And what's so interesting about what's happening right now in crypto, the contagion, the counterparty risks, is what a lot of people are learning, and strangely enough, a lot of people don't realize in traditional finance, is that their deposits with a financial institution it's basically a loan to that institution. Your bank deposits, you're a creditor, right? You're lending your money to the bank. The fiat world, our current financial system, the banking system, is a Ponzi. There's always and perpetually needs to be more debt than there is money to pay it back. One might argue it's a bit more sustainable than what we've seen in this nascent early stages of crypto, is partly because it's regulated. Of course, there's criminals that actually do real Ponzi schemes outside of what the banking regulation allows. But there's also elastic money. So when things get too silly and there's too much risk, and ultimately things implode, like you said, there's at least that elastic money supply that can come in and fill the hole. Now that creates a whole moral hazard all its own. I don't think anyone who's in crypto is a fan of these bailouts and this, the way central banking continues to kind of plug up these holes that they create and ultimately exacerbate and make more problems. But now what we're seeing, it's a similar structure here in crypto, but the difference is we don't have that elastic liquidity. We don't have the lender of last resort, being the Federal Reserve or central bank, who can print money for better or worse to come in and fill in the gap. So we are seeing the cascading liquidity issues from these counterparties, where there is no one to stop it. And people, I think, in TradFi, especially those who are very anti-crypto, are dancing on graves right now, right? They're having a field day. Crypto's down across the marketplace. The top 1,000 are down over 80%. Bitcoin's down 70+%. Would you say, though, that this is certainly for the institution you work for and just people in general, they want to protect themselves from these issues, but would you say this is actually a healthy part of crypto, and that this, careless risk taking and the counterparty effects of this, the people who've gone too far out on the risk curve and exposed themselves inappropriately, as painful as it is, they're getting wiped out? But that's what's supposed to happen. It's like the wildfire clearing out the dry brush. It's recession gets the bad rap as this horrible thing, but it's actually intended to clean out the dead weight. Do you see this, ultimately at the end, making crypto stronger, and even in this current market environment, how close do you think we are to the point where we find that bottom, and as the remaining participants build this industry back up even better?
Yeah, so that's a super interesting question. And it touches on a few different things that I think are important to cover to fully answer it. The first being our traditional financial system, in which if a lot of I don't think many people know this either because it's a quite frightening statistic, but when you give your money to the bank, they used to have a reserve requirement where they had to hold 10% of it at their bank. And then the other 90% they could, loan out to someone else or invest or whatever. During COVID and the pandemic, the government actually dropped that requirement to 0%. So they're not required to hold your reserves. That is a big problem. If there was a run on US dollars, meaning everyone went to the bank to try to get their dollars, we would definitely see a collapse of our financial system pretty quickly. But what you're saying, and what is a very good point, is that our system does have the money printer and policies in place to mitigate that risk and subdue the fear enough to where that at least hasn't happened thus far, and probably will continue to not happen unless there was a massive threat to the dollar or something like that. In crypto, as you're saying, we don't have that because there's a finite market cap on many of these coins and tokens, especially, Bitcoin. ETH will be deflationary after the merge. So we can't just print money from a centralized institution to mitigate that risk. With that said, I believe in the fundamentals of crypto so much. It's my passion. It's why I left traditional finance. I think it can help people all over the world, especially in developing countries. But I do think it's still very early stage and it is an experiment. We're still developing regulation around it, country by country, state by state. And we're seeing what happens in a market shock in which we had developed instruments so that people could take extreme leverage. And we saw how that shook out after a huge collapse of, one of the larger ecosystems within the space, that being Terra Luna. So it is an experiment. And right now we're seeing what it's like to experience such a market shock in a market with so much leverage, with no money printer that can help bail people out, and with no FDIC insurance on these platforms that operated and looked very much like banks that we're familiar with. Celsius, Nexo, BlockFi, they were all extremely user-friendly, and you would think it was just like your bank account website, except probably even better user experiments and user interface. So we're seeing what's happening without the money printer, and it is very, very sad. I think it is shaking out a lot of people that took too much leverage, and unfortunately, that's just what is going to happen in a largely unregulated market. And we see that in our traditional economy as well. When you kind of raise rates we're setting ourselves up for a recession, and so when you're raising those rates, a lot of smaller businesses will go out of business because capital isn't as cheap to borrow to sustain their operations, or you're seeing less businesses get started, and things like that. And that's kind of what we're seeing in the crypto space as well, just shaking out some smaller players that couldn't make it. And there really aren't any bailouts. So I think it's a really hard lesson for most. And it's also a hard lesson on the fundamentals of crypto, because a lot of people were using Celsius to get a 6% yield on their stable coins, or whatever, or a higher yield on some altcoins. But one of the fundamental reasons why crypto was created was so that people could have self-custody of their assets, and hold their private keys and have that financial independence. So and a lot of people always ask, where does the yield come from these platforms? And sometimes it was transparent, sometimes it wasn't. And now we're learning that the yield did come at a risk. Every yield in pretty much any industry does, and the market determines what that is. But I think this is necessary for the growth of the ecosystem. Personally, I did not think we would see Bitcoin get below 40,000 again. I didn't think that that was possible. And I think that I was viewing Bitcoin from my idealistic utopian perspective of, this is sound money and I understand the fundamentals and there's a finite market cap and we need a money like that. And I was ignoring the fact that despite that, it is performing in correlation with, the stock market and tech stocks. And until we see that decouple, I think that Bitcoin is still going to, I think that we need people to understand it and decouple. And then a market shock like this wouldn't have as extreme of an effect. But I think that I thought we were getting there with institutions on board and all this institutional money. But now I'm realizing we probably need like a much larger market cap, maybe 10 or 20x where it was at before we see some of that volatility subside and it hopefully decouple from the stock market and risk assets.
So I have a question here that's a bit of a thought experiment, but it's continuing the theme that we're on. If I was sitting around and chatting with a bunch of traditional finance guys and hedge fund guys, and it was purely, like I said, a thought experiment. I'm curious to propose the question of, like you were saying, maybe it was your own crypto utopia, but you couldn't really have fathomed Bitcoin going under 40,000. When I look back at this and we look at how quickly this thing has spread, and it really is the theme of the call, counterparty risk. I can't help but feel we would never, ever be here. And of course, the TradFi guys would say, well, this is what happens, right? This is what happens without regulation. This is what happens when you can make bets on 100% margin. This is what happens when you play with, opaque, fake internet money and people promising yields that are unrealistic. I mean, a lot of people, because interest rates have been suppressed for so long, just like they don't understand the idea of giving your deposit to a bank is a loan to the bank. A lot of people have lost the connection with the idea that an interest rate is the price of money. It's, the risk you're willing to take to put your money on the line, because price discovery has been so muted for so long because of the Fed. But backtracking here on the point I want to make and the question I have for you, we are where we are today, but it really feels like whoever the actor was and whatever their intentions were that tried to and successfully crashed UST and brought down Luna, we wouldn't be where we are today. It doesn't mean those counterparties weren't an issue and potentially down the road wouldn't have blown up for some other reason. We don't know that, but it definitely feels like although a bear market, it wouldn't be this deep or this ugly if we didn't have this massive liquidation and then all these counterparty risks unfolding. Your thoughts on that?
Mhm. Yeah, definitely. And I think that's also where naivety came into play, at least in my perspective on the market and where the bottom was, is coordinated attack wasn't on my radar. I mean, I guess I knew it was a possibility, and there's always hacks and things like that. But, it seems like the general consensus is that there was an attack on the Terra Luna ecosystem, and it was coordinated by some larger players. And that's a risk I hadn't looked at. I'd quantified all these other risks, but that's a tough one. But when you have a market with less regulation and less protections, and you have people with a lot of money with a relatively low upfront cost or risk to them trying to game a market or collapse a market, because if they all sell off at once or something like that and it doesn't affect the market like they thought it would, they just kind of buy back in and maybe lost 1% or 2%. And if it works, there's huge reward for them. So it's not illogical. And it's something that unfortunately did happen. And then Terra Luna was just such a high market cap project with so many people that believed in it, and also offering, I mean, something that seemed too good to be true, which was 20% on a stable coin, 20% yield on a stable coin, that felt very safe. And a lot of people thought it was too big to fail. I think that's kind of also the theme of this downturn, is too big to fail is something that should not be, we need to kind of unwrite that from existence, because we're seeing that all over the place. And if rumors of Three Arrows Capital being insolvent, everyone thought they were too big to fail. Everyone thought Celsius was too big to fail. Everyone thought,
Lehman Brothers.
yeah, exactly. And that's the thing, is this extends to both history in traditional markets as well. I don't think it's isolated to crypto markets, but I think that is one part of counterparty risk that shouldn't be, you just shouldn't have that mindset about things. I think that it's really, really sad what this has done to so many people that got their feet wet in crypto and got into UST for what they thought was a safe yield. But it also speaks to the fact that markets are generally efficient and yield generally correlates to risk. So yeah, I think that it is, yeah, pretty unfortunate what happened there, but I don't think we'd be seeing all these liquidations or this downward price movement for Bitcoin, ETH, and the whole market if it wasn't for the Terra Luna collapse. And then I wonder if maybe we would have had another big experimental project, because yeah, Terra Luna was also, and UST was also an experiment. It just was a very, very large one. But you wonder if maybe another project this would have happened to, and maybe this is inevitable in a market with so little risks, but that's impossible to know, I guess.
Well, as an actuary, we lean on you to give us at least the probability of impossible. I have one more comment, one more question, and I'm going to let my friends here on the call jump in, since I've been hogging the mic for 25 minutes. We're talking about interest and yield and the risks associated with that. And, obviously a higher yield should mean to people higher risks. 20% interest, it should have spooked everybody just in itself of that. But we're talking about, or earlier on you mentioned the savings rate being 7 basis points, 0.07.
Mm-hmm.
I think that's generous. It's basically even less than that. And because of that, because of this suppression of interest rates, and because even before this year and before 2020, if you believe that inflation was running at the Fed's target rate of 2%, and similar types of things were all true, despite what the real numbers tend to tell us, then anyone who's putting money in the bank is by minimum losing 2% a year. Mm-hmm. Do you feel, I think this is more maybe a philosophical or an ideological question, do you think the Fed in a lot of ways has blood on their hands in this crypto bear market, because they've forced people to go out onto the further out on the risk curve? Yep. They've forced people into this almost religious belief in crypto, particularly in Bitcoin, because they've been left with nothing else to hold on to.
Yeah, absolutely. And this is something that I feel so strongly about. I'm glad you brought it up. It is so funny, funny in the most cynical sense of the word, how, the Fed has just completely not taken responsibility for anything that's happening in the markets. Biden was publicly said a few days ago, that he thinks it's, what was the word? Basically, he thinks it's like unrealistic, or it's very far out to think that the Fed policies and our money printing had anything to do with the current downturn in the market. And am not up to date on what the number is now, but I know as of 2021, if you think of every dollar that was ever printed since we started printing dollars in the history, of our Fed, every dollar, how many of those were printed in 2021? The number is estimated between 35 and 42%. And so another way of saying that is we increased our monetary supply by, close to 60%. So if you do that in 1 year, you're going to see crazy inflation. And the Fed said it's just transitory. Once it started happening, first they said it wouldn't happen. And when you do something like that, you are, one, giving everyone more money and increasing the monetary supply. But when you're doing that in conjunction with lowering interest rates to near zero, all that does is push people out on the risk spectrum, because anyone who understands inflation or hears about it realizes, oh, wow, I have to put my money somewhere. And jumping back to our point about how our current financial systems do have the money printer behind them that can, protect against these cascading liquidations or just run on banks and the dollar. In crypto doesn't have that, but the cost of that backstop is that when they print money, that is an invisible tax, an unofficial tax that is placed on every American. So everything gets more expensive. You pay your yearly income tax, and then you pay taxes on everything you buy. But as the Fed prints money and increases the total money in the economy, prices also rise, and then you're paying that invisible tax of inflation as well. And that's something that is bad in itself. Then you put that together with lower interest rates, and yes, people are pushed so far out on the risk spectrum, especially if you look at, people. I'm pretty young. I'm 24, so looking at kind of how much I have to plan for retirement, factoring in inflation and all these things, I can speak to at least my generation where we have to plan very early. And if you're factoring in a interest rate of 0.07% per year, that is pretty disheartening and makes you realize you can never retire. So then you say, okay, what can I do? Well, there's yields in crypto. And it definitely got a lot of people onboarded because of those market conditions. And I know that a lot of people who are younger also feel like there's not really a chance to be able to even just sustain your wealth throughout your life to the point that you can, retire at when you plan to and all those things without investing in risky investments and getting it right. So you also see, the cost of housing going up. So real estate becomes a less viable source of, invest or less viable investment option for a lot of people. And then when Fed starts raising rates, a lot of money does flow out of risk assets. So it should have been predictable that this would happen once they started raising rates and announcing that they were going to continue to do so. But that's where people had to make a judgment call on if the fundamentals of crypto and how it really should be an anti-inflationary asset, because there's a finite amount of most of it for most tokens, if that would beat out the correlation with the risk assets. And we haven't seen that happen yet. Long term, I would hope so, but in the short term, it does seem that the Fed increasing rates is crashing this market, and I think it will continue to do so, unfortunately.
Well, this is the Crypto Alpha podcast, and I am the resident traditional finance nerd. So I've steered this conversation down that rabbit hole far enough. So I want to take us back and maybe discuss a little bit more crypto, your role in that, and some insights you might be able to share in that regard. So I'm going to bring Brandon in to kind of maybe take over the mic for a hot minute.
Thanks, John. What hit me was Hannah, you saying where you're at age-wise and what you're looking at and what you're thinking about trying to prepare for specifically with you. I may be dating myself when I say this, but when I was a little bit younger than you, coming out of high school, the national debt was, I think, $3.5 trillion. And I think this weekend I saw it was 30, somewhere thereabouts. So what's funny about that is I thought, wow, by the time I retire, it might be $6 trillion. So it was considerably more painful than I ever even imagined it was going to become, being at an earlier stage in life. So my heart goes out to you in that context. What I saw that was interesting, like John said, being from more of the traditional world, he said the first thing that all these people should have realized is that 20% on a stablecoin yield should have been spooky and it should have scared people off. But I really got involved in crypto and didn't really touch the traditional world. So my reference point comes mainly from crypto. And I know many, many people that think 2,000% is a small return on gains in crypto. So when you looked at 20% looked like, wow, that is boring. That's gotta be safe. So what that brings my thoughts to is talking about the old and talking about the new. How crypto, we're 24/7 here. It's not like the traditional world where it's Monday through Friday and the market's working 40 hours a week and then, sweeping up after hours. It's constantly moving. So, I feel like we see a year go by and it's probably what traditional people would have experienced a decade to be. So I think we're speeding towards parity with the traditional ecosystem, trying to catch up to that. So my real question is, what do you think it's going to take for DeFi to not be called DeFi and it to be called finance? I see the same kind of experience with NFTs are trying to fight to become art. And I think that as all of these things are accelerating, we're going to get to a point where they're traditional. But what are your thoughts on what it's going to take and what it's going to require for us to call DeFi finance?
Yeah, that's a good question. So first of all, I would say some of us are too proud and maybe we don't want to be financed. No, we just don't want the blood on our hands of the current financial system. But I do think we'll get there. And I think there's good things to that as well. And I understand that the premise of what you're saying is, DeFi won't be this fringe thing that people are investing in. It will just be part of the financial ecosystem and, kind of have achieved mainstream adoption. And many people will be using these products. So I am a DeFi nerd as much as I am a math nerd, and I love learning about all of these new projects that are coming out. I get super excited about them. And with that said, I still think probably I say, 90 to 98% of these projects will go to zero or near zero and will not be around in a few years. But I think I'm going to just say probably 98% of those. I'm going to say the other 2% though, that, survive and adapt and become even more user friendly. Those 2% is going to be what's considered finance, and people are going to use without realizing it. They'll be integrated onto, probably traditional finance platforms and seen as a viable option for investing, and a portion of people will do so. So I think, what will it take for us to get there, and what will determine which 2% of projects that those are? We're about to see a few crazy years of regulation for sure around all of these things. Two bipartisan senators last week released the first bill to try to regulate some of this space, crypto and DeFi, and it's a very crypto-friendly bill. It will take probably, from what I've heard, 2 to 3 years to refine it to the point that it's passed and, used in legislature, if this one does pass. So we're going to see 2 to 3 years of figuring these things out. And a lot of that bill was just defining what some of the things in this space are. And anyone who knows this space knows that in 2 to 3 years, we will have a lot more definitions to come up with. But I think regulation is important. And if you would have asked me 2 years ago, I mean, in my crypto utopia future vision, regulation was not part of it. But now that I've, worked a little more in both, I have traditional finance under my belt, but also just kind of I've been studying a lot more about politics and economics and the history of both. I do think that regulation is a necessary step in order for this to become finance, and to put some more trust behind it. We'll see what form that regulation takes on. I would guess that we're going to see a lot more KYC. We're going to see some limits on leverage, and things like that, which would, in a situation like this, reduce some of the volatility and some of the magnitude of, downward trajectories. So I think we'll see some regulation. I think that a lot of these really cool projects are going to be proven to be a little too fringe or a little too catered to people on crypto Twitter, because right now you have to be pretty in the space to use some of them, and it's very uncomfortable for a lot of people where you have to send currency between 2 to 4 or 6 different wallets and trade using a decentralized exchange or a centralized exchange. But there's lots of different transactions to get your money to the end protocol that that utilizes the DeFi product that you're looking for. I think we're going to have to see things get a lot more user friendly, so that it's just one transaction and people feel a lot more secure about it. And once we see that happen and some regulation, I think that we will see a portion of these DeFi products end up being finance. And I think we'll see that because with smart contracts and essentially digital money, it's programmable money. With programmable money, you can do things that are peer-to-peer. So my one huge hope for the space and why I really do believe in it long term is there is so much value add when you have something peer-to-peer. Just like I can lend someone money that I've never met through a smart contract that requires no trust from either side, and executes our terms automatically. So whereas before I either wouldn't have the opportunity to lend out my money to someone because it's not enough, or I'm not high net worth enough, or I have to go through a middleman to do so, the middleman is taking a cut. We see that with loans, we see that with mortgages, we see that with pretty much every financial institution, even just payment processors. GoFundMe takes an insane cut, whereas a DAO like Giveth.io is an amazing nonprofit DAO. I worked there for a year too, but they're essentially a Web3 GoFundMe that doesn't take a cut, and you can send currency across borders for free. So whenever you're making a market more efficient, you're adding value, and there's an insane amount of value in peer-to-peer programmable money. And there's DeFi projects that will be built around that, and they will make it super user-friendly. And even though right now it seems like we're in a bear market, perhaps entering a crypto winter, so many of these DeFi projects and protocols have gotten funding already from VCs and from investors. And a lot of VCs still have capital that they're looking to allocate. So what that means is that these DeFi projects are building and they're continuing to improve their products. And even if this crypto winter lasts 2 to 3 years, or until the next halving cycle, or something like that, these protocols are building, and as they're doing so, they're adding value because they're improving these technologies. So whether that's making them more user-friendly for the existing products or creating new products, there is innovation in the space, and that captures value. So I think that, like I said, 2% of those will hopefully make it. Maybe 98% won't, and maybe that is a completely wrong estimate, but in most industries, when you see this much growth, you see, a lot of people fail, but you see the ones that don't fail really change many people's lives worldwide, that have access to them and have access to internet and things like that. So I think that's what it'll take for some of those to be DeFi products to be considered finance products.
That's an awesome answer. It's also a painful thought to think about your 2%, 98% ratio. I wanted to reach back on that because when you say that 98%, it leads me to think that not all of those 98% failing are going to be due to themselves even. And the reason I bring that up is you did bring up Three Arrows and their spectacular implosion, which I think if we look at Terra being the proverbial pin that popped this bubble, that's what took out Three Arrows. And I think that we haven't seen the completion of this whole process because I think that there's probably quite a few products, services, platforms, ecosystems that are under that Three Arrows umbrella that may have had a great product, but because of their exposure or that participation, they're going to fall into that 98% clump. And we may lose some good things that just got dumped because people are trying to recoup a loss and make a situation whole. So thinking about that, what I'm interested in finding out is what would you say to a new project that is going to try to fill that gap for that 98% that's going to be open? How are they going to get people to coalesce around what they're creating, even from your side, looking at it in an actuary context? What is it that they can do to put themselves at least a head start into jumping into that 2% pot for the next time we come around?
Yeah, so I think one thing to just note is that kind of the Three Arrows and Celsius and all of the things, the fallout we're seeing from that is more CeFi or centralized finance. And then I might, just to clarify, my prediction is more for the 98% of failures within the DeFi and crypto startup part of the ecosystem. But definitely they are very interrelated, as you know, Luna, like you said, was kind of the pin that popped Three Arrows. So I think what future companies are going to have to do to try to kind of become, have a larger chance of survival is definitely just learn from this, which is easier said than done. But I think one big market sentiment that can be taken out of this is there weren't as many backstops or as much protection for users. So if you look at the history of DeFi hacks, which was probably prior to this considered to be the largest risk to investing in a DeFi protocol, in most DeFi hacks, the protocols actually either made a deal with the hacker and recovered like 80 to 90% of the funds, because if you hack someone for $200 million, it's really hard to deposit that into a bank where you live. So they would kind of make a deal, or they paid users. If users' funds were affected, they paid them from their treasury. So if you look at every DeFi hack that has happened since DeFi started, that's the case for about 80 to 90% of them. And looking at that I think was seen to be the biggest risk. And then now we're kind of seeing, okay, the risk, there's also a risk of that, everything has been interconnected, and the magnitude of a large shock to the market on the downside can be very, very painful for most. So in the future, I think within the entire DeFi ecosystem, we're probably going to see protocols come out with more ways to mitigate the overall risk, whether that's products that, function more as insurance or more maybe DeFi strategies that utilize hedging to hedge against the downside using, different options strategies or something like that. I think there could be a market for, or if there are DeFi projects working on that now, maybe they'll put more of an emphasis on that. Also, I think, trading on volatility is a good way to hedge against downside risk, just having some options available to users within the DeFi space in an not eco-friendly, in a user-friendly way that offers a way to kind of, obtain yield if there's high volatility within the market. I think we'll probably see some of that instead of the bullish up only, mania that we saw now, where it did seem like, oh my gosh, we're all printing money and we're going to keep doing this forever. WAGMI, we're all going to make it. Everyone will be rich and millionaires in a few years. I think that we saw that might have been a little too bullish, and we weren't really saying we're seeing all this money flow into the ecosystem because there's a lot of new money in the world due to inflation, and also there's really low interest rates right now. And that was just more of, we've covered that, but it was very situational. So I think within DeFi, we'll see more of an emphasis on hopefully risk management and ways for consumers to obtain protection. I would assume that a lot of those will be built out in decentralized ways. And I know there are, some there were basically like insurance products within the space that were decentralized, like Risk Harbor, Nexus Mutual, Insurace, to name a few. But they were more protecting against hacks versus just something like this. So maybe we'll see some products built out around current events just to make people feel safer. But that's just, part of the evolution of this market. And also, just as we were saying earlier, we haven't seen a market this decentralized and unregulated without a money printer behind it. So I think we'll hopefully see some decentralized risk mitigation techniques that do not require a money printer so that we can keep evolving the space.
Well, I'm going to go ahead and schedule an appointment to get my WAGMI tattoo covered up. But in the meantime, John, Andrew, I'll throw it back to either of you, and let's see where we go.
Sure.
Thanks,
I'll ask
Brandon.
one question. Sorry, go ahead, John.
No, please.
Yeah, I'll ask one question that we talked about off recording when you were talking about how you noticed some risk factors a little before this most recent Celsius lockup. Could you maybe tell us a little about what you saw and why that caused you to sound the alarm amongst your family and friends?
Yeah, definitely. So one thing not to be underestimated is all the data we have at our fingertips. So we have, on-chain data for a lot of these things. And one thing that I saw was from my primary source of information within this space, which is Twitter. If you're not already on Twitter following some crypto analytics people, I'd say do that to be informed about the space. It is underrated. But someone that's always kind of doing on-chain analyses noticed that Celsius was insolvent on their ETH position and that they only had 27% of their ETH liquid. So looking at user funds, I guess they couldn't see user funds, but pretty much it became clear that if users did go to Celsius and everyone tried to withdraw their ETH, Celsius wouldn't have enough money to pay that out. So their ETH was 27% liquid, and the rest was either staked ETH, which won't be liquid until after the merge, and the merge date is unknown. It's been pushed back a few times now. And then also they had, their ETH either locked up in other ways. So they were doing that to get users yield on that ETH, where that's where the risk comes in. But once I saw that, I started thinking, okay, if you look at this system and 27% of people withdraw their ETH, those 27% of people get 100% of their ETH. and the rest of people get 0. Then staked ETH depegged, meaning normally staked ETH was redeemable or was trading for the same price as 1 ETH. Now it's about 5% less. It's been fluctuating between like 5 and 7%. So it's trading for 0.393 to 0.95 ETH. Basically, that does make sense because it's less than ETH because of a liquidity premium, because you can't get access to that ETH right now, and a risk premium on, what if the merge fails or something like that. So a slight discount makes sense, but then you look at it and you say, okay, now Celsius's ETH that was converted to staked ETH is worth 5 to 7% less. So now they have even less ETH to pay out. And that was enough for me to sound the alarm bells to family and friends and say, hey, this is something to watch. This is public now and people can see this data. So if people do start to panic and withdraw their funds, it wouldn't be unreasonable for Celsius to freeze account withdrawals. And some people met me with, that's FUD, don't spread that. But most of my family and friends were able to get their funds off in time. And also, if we backtrack a little bit to Coinbase's public statement a few weeks ago, where they said if they were to declare bankruptcy, every crypto that was on their platform is in their custody, and they would have to freeze accounts. No one can withdraw, and they would sell those assets to pay preferred shareholders. So they released that statement. Celsius wasn't a publicly traded company, so I tried to do some research on what would happen if Celsius became insolvent. And they're basically, in the terms and conditions, you agree to, if your funds are on their platform, those are theirs, and they can do whatever they decide to do with them. So it wouldn't be unreasonable that they did the same as Coinbase, or a publicly traded company in that case. So that was kind of my mindset around it. And at the time, my actuary brain, I told people, I put a 10% chance on this really happening, but 10% on a full loss of 100% of your funds is quite a lot. So I just kind of advised my family to put everything into cold storage for the time being that was on Celsius. But that was a little bit of the mindset behind it. And I think that is where, somewhere to look is just kind of keep track of the on-chain data and analytics. And if there is market volatility and someone has custody of your coins and has your private keys, it's important to get those into your own hands and sleep a little easier at night.
Thanks for that, Hannah. Brandon, good question. Andrew as well. Now I've done a 4-hour podcast before in my life. I'm trying with the Crypto Alpha podcast to keep them around 30 minutes. We've already doubled that, but this has been such a compelling and interesting conversation. I can't thank you enough for your time. Before we wrap up, I think I want to hit you with 2 more questions. One, kind of backtracking a little bit to what Brandon was asking. As an actuary, as someone who's a DeFi specialist, and you're looking at these various projects and protocols and looking under the hood, do you have, or perhaps can you disclose a few of the things that are on your checklist? Like when you're approaching these projects and trying to decide, do they, number one, have a future as a project, but maybe trying to uncover where some of those risks lie? Like how do you approach that? How do you assess and or value something when no one else has yet?
Yeah, definitely. So, personally, I invest in the space, and this is always a question that I ask myself. Also, take none of this as financial advice, but in terms of just kind of looking at a new project or protocol and trying to see some of those risk factors, a few things I look at. One is, I touched on it earlier, but looking at, say, Etherscan, or whatever chain scanner that chain has, looking at the token and the token distribution. So you can see from the on-chain data how many people hold how much token. So you can see, oh wow, like 18 people own 51% of this or of this protocol's governance token. So 18 people can make decisions for this protocol. I'd say that's kind of a high risk. And crazily enough, that's actually the case for MakerDAO, which is in charge of DAI. So currently, at least last I checked, which was last week, 18% of people did have 51% of Maker. So this massive institution with the most successful algorithmic stablecoin that so many people use is a lot less centralized than I thought. So looking at that is always important. That also can help give you an idea of how many whales are involved in the project. And, if they did coordinate an attack or something, then you can see, wow, if someone has 4 to 8% of this token, it's not very distributed. And if there's a lot of whales, they could coordinate and crash the price or rug pull. That's one thing I look at. I also look into the team. I think that that's something that isn't as quantitative as I'd like as an actuary. And even less so for you if you don't like the, opaqueness of statistics, but looking into the qualitative, metric of the team, I think that's really important. Just seeing their history, what other projects they've been a part of, how long they've been in the space, and also, the success of projects that they've contributed to. I think that's a very underrated and important thing to look at. And that's something that with time, it'll just become more clear, kind of how you'll get more comfortable in kind of are attributing a certain risk factor to a certain team. Looking at companies that have backed and invested in early stage DeFi projects and startups is also a good metric, I think, because if a larger company that has done pretty well with their prior investments in startups has invested, that startup has passed their own kind of risk analysis, and they think that there's potential there. Also, if there is a crazy yield, figure out where it's coming from. Even some DeFi projects and protocols, they'll put a yield on their website. Make sure that you're actually getting paid that yield, because sometimes they put a number up and you're actually not making that much. So definitely check that, and don't just take their word for it. And then also, if you're earning, like you were saying, 2,000%, you're probably getting paid out in a very small market cap coin that is very inflationary. I think looking at basic tokenomics metrics, I won't go too into that, but just looking at if there is a finite supply of that token, like that's important so that they're not just endlessly inflating. Because if they are just printing more and more token, then if you're not staking it or earning additional yield, you're just losing value there. So I look at, token supply and their supply release schedule to see what the inflation will be, make sure that a yield is higher than that. And then also, if you're staking a DeFi token and earning 2 tokens of smaller market cap, just be very aware that those might not be that worth, or might not be worth that much down the road. And those might get rug pulled on. So those are a few things that I look at. Hopping in a Discord too, if it's a very early protocol, is good to just ask some questions and see how long the team has been working on the project and how much thought has gone into it. That can be helpful as well. So these are all things that are definitely very specific to DeFi and different from finance, but you can apply certain traditional financial metrics as well. But I think that this space requires a pretty special risk analysis.
Agreed. And it's been a battle cry of mine for a long time of how important the team is, because I think so much of crypto has kind of wrapped itself around the meme, right? I mean, you even see it in traditional finance with AMC and the rest of it. But as much as everyone wants to talk about decentralization, someone's got to drive the cart, right? Someone needs to push this initiative, the white paper, the project forward. And so ultimately these things, as decentralized as we want to pretend that they are, they need leadership, and they ultimately operate like a business, and it becomes a lot easier. You can sometimes push the tech part aside. You don't need to be a crypto, you know, you don't need to be the most techie crypto enthusiast on the planet to kind of get a sense of like whether or not you're dealing with something that's going to potentially create value or can survive bear markets like this, because a lot of times these things actually are businesses and or should be treated or looked at like they're a company. And when it comes down to it, you know, the strength of a company oftentimes comes down to the strength of the CEO and the executive team. So I certainly agree team is important. And it's funny you mentioned the MakerDAO, and just DAOs in general. If you've ever worked with one, you know, I think I wonder if we'll eventually get to a point where there's a recipe or a secret sauce to kind of evaluating DAOs, because it feels like DAOs are going to be the next thing. And it feels like this cycle was NFTs. DAOs are probably going to be a big part of the next one. And that's certainly something here at Crypto Alpha we're going to monitor and participate in and help people take advantage of the right way. But it's interesting when you're involved in these DAOs, like everyone loves the idea of decentralization until a decision has to be made. So in some cases, maybe MakerDAO, the 18% whale calculation you've kind of figured out, maybe they've accidentally stumbled on you know, the secret recipe of just the right amount of spice that you need in terms of centralization, so that initiatives can get pushed through, because otherwise you have 1,000 people in a Discord arguing about things that ultimately are erroneous. So definitely some interesting things to think about there, and another time maybe we can dive into. So before we wrap up, I want to give you, drop one more question on you. You know, bringing it all back, we're still in the midst of a crazy, chaotic bear market. Like I said, we've had a bit of a small bear market bounce, perhaps. I'm not as confident that we've seen the bottom, or we have reached the floor. But would you say at this point, as an actuary who's looking at these counterparty risks and all the things that have been unfolding, do you feel that contagion is done? Or do you have fear or concern that we still have a few more innings to go in this bear market?
I hate to be the bearer of bad news, but what I think is that we'll still see this continue to shake out for a little bit. I think that we will probably see more market shocks I mean, rates are still predicted to increase. If that does, you know, drop prices, as you know, it will probably drop the entire risk on asset market. Then with basically how it works is every time the asset price drops, you see a new round of people that might have been over leveraged, whether that's, you know, large institutions or whales. You see them getting margin called by their counterparties, or wherever they've taken leverage. And some of them will be able to meet those margin calls and some of them won't. And then you're going to see them have to sell off their asset or their loan get liquidated. When you see that, then you see even more sell pressure on the underlying assets. In this case, mostly, you know, we're talking about Bitcoin, ETH, and the other cryptocurrencies. So I think that just given the general macro environment of likely a recession coming, further increased rates, and then also I think that it will take some time to see everyone that, you know, if Celsius does say declare bankruptcy, everyone that Celsius either owed money to or invested in, you know, we're seeing that capital kind of dissipate from the market. So that will affect people. And this will take time to see who can remain solvent and who goes insolvent, and shake out those weaker players or the players that just didn't focus enough attention on risk management. So I think we'll continue to see it shake out, unfortunately. But hopefully there's light at the end of the tunnel, and that will just lead to an overall safer environment for investors in the future.
Excellent. Brandon and Andrew, I apologize for hogging the mic on this one. Hannah, thank you for filling the air for over an hour with your thoughts and knowledge and experience and wisdom. It's been a joy for me, and I'll speak on behalf of the other two to say the same. Where can people find you, connect with you, communicate with you?
Yeah, so my Twitter is the where I post some of my thoughts and observations. That's at Hannah Jo Hannah Jojo HANNAHJOJO _ because there's an abandoned account from 2012 or something that took the Hannah Jojo, but otherwise I'm Hannah Jojo pretty much everywhere across Discord, GitHub. So yeah, that's where you can find me, but Twitter is definitely the best.
Fantastic. Brandon, Andrew, any last words before we wrap up and let Hannah go on her day?
Thank you. It was great, really insightful, and hopefully we can have you back one day.
I'll echo the thank you. It was a great chat and very enlightening and useful to get some new eyeballs and some new reference point. Definitely. Thank you so much.
Yeah, thank you so much for having me. It really was a pleasure, and I could definitely talk about this stuff all day, which most of my family, friends, and my roommates will tell you.
Well, thank you. We can't thank you enough. And it does seem like we will have you back on in the future to continue the conversation, and we can all geek out on it together. So that'll do it for this one. Thank you so much to Andrew, Brandon, and again, thank you to Hannah, and we'll see you next week.